Welcome back to Deep Dive. And today, we're not just reading a book. We are, let's be honest, we're trying to survive one.
That's a good way to put it.
We're looking at Accounting for Equity Compensation, the 20th edition. It's the Bible. But we're not trying to boil the ocean today. We're going straight to the engine room.
Chapter 5. Expense Attribution.
Exactly. And I call it the engine room because, correct me if I'm wrong, all that other stuff, black holes, fair value, volatility, it's all just theoretical math until this chapter.
You're absolutely right.
This is where the numbers actually hit the P&L statement.
That is the perfect way to frame it. You can have a perfect fair value number, down to the fourth decimal point. But if you mess up the attribution, the when, or the how, your financials are just wrong.
And for you listening, if you're prepping for an exam.
Oh. Chapter 5 is notorious. It is just full of these nuanced rules that look almost identical, but they give you totally different answers.
Right. And that's our mission. This deep dive is for you, the person staring down an exam on Chapter 5. Well, we're not defining what a stock option is. You know that. We are hunting for the traps.
We're looking at sections 5.1 through 5.2.6. We have to cover the service periods, the attribution methods, and, that huge disconnect between market and non-market conditions.
Okay, but before we get into the weeds, just for a second, why is this so complex? Why can't a company just say, hey, we gave the CEO $1 million in options, let's book $1 million in expense, and be done with it?
The matching principle. It's the bedrock of accounting. You have to match the expense to the period where you get the benefit, which is the work.
So if it's for 4 years of work, you spread it over 4 years.
Exactly. You're paying for 4 years of future service. It would be totally misleading to just dump that cost into Q1. Your earnings would tank. Chapter 5 is basically the rule book for spreading that cost, or as you said, spreading the butter on the bread.
Okay, let's stick with that butter analogy. Section 1 is the service period. That's the when. To me, that's just the vesting period. 3 years to get shares. The service period is 3 years.
It's simple around.
In the real world, maybe. On an exam, absolutely not. Section 5.1.4 lays out 3 very distinct flavors of service periods. You have to know them.
Okay, hit me. What are they?
So the first one is the explicit service period. That's what you just said.
Right in the contract.
Yep. Vests after 3 years of service, stated clearly. That's the easy one.
Okay, I can handle that one. What's number 2?
Number 2 is the implicit service period. This is where vesting is tied to an event, not a date. Like, these options vest when the new software platform launches.
Right, but you can't put software launch into an accounting system. You need a number of months.
Exactly. So management has to estimate. They think it'll take 18 months. Your implicit period is 18 months. But here's the trap.
It can change.
It can absolutely change. If the project's a disaster and gets delayed, you have to adjust. You spread the remaining cost over that new, longer time. So implicit equals estimate, and that estimate is fluid. Got it. What's the third type?
The third is the derived service period. This one is only for awards with market conditions.
So like vests if the stock price hits $50.
Yes. Now, your brain might say, okay, we'll just estimate when we think it'll hit 50, but no.
You don't guess.
You do not guess. That timeline is derived from the valuation model, usually a Monte Carlo simulation. The model runs thousands of paths and says, mathematically, the median time to hit $50 is 2.5 years.
And that becomes your service period, 2.5 years.
Precisely. And here's the exam critical part. Unlike the implicit period, the derived period generally does not change.
So even if the stock tanks and it looks like it'll never hit 50, you stick with 2.5 years.
You stick with the 2.5 years from the model. It's a rigid timeline versus a flexible one. You've got it.
Okay, sticking with timing. I see this term in 5.1.1, service inception date. Now, like 99% of the time, the clock starts on the grant date. Why do we need another term?
Because of the edge cases. And edge cases are testable. Sometimes you can actually start expensing before the grant date.
How is that even possible? The award doesn't legally exist yet.
It happens when 3 stars align. 1, the award is authorized. 2, the employee has already started the service. And 3, the terms are basically known.
So if you tell someone, start working today, we'll give you 1,000 shares at the board meeting next month.
You might have just triggered a service inception date that's earlier than the grant date. You're booking expense in a sort of legal limbo.
Okay, what about a more common scenario? New hires, section 5.1.2.
Yes, this trips people up all the time.
So you hire someone on January 1st. Offer letter says vesting starts from your hire date. But the board doesn't actually approve the grant until March 1st.
You've got a disconnect. The employee's clock started in January, but the accounting clock can't start before the grant date in March unless you met those really strict criteria we just mentioned.
So what happens to January and February's expense? Is it just gone?
No, you have to catch up. On March 1st, you have a compressed period. You have to book the cost for those first 2 months immediately.
Like a catch-up entry.
A catch-up, and then you spread the rest over the remaining time. So you're squeezing a 4-year expense into 3 years and 10 months.
Which means the expense per month is actually a little higher than normal.
Exactly. You catch up the P&L to reality.
All right, that's the when. Let's move to the attribution methods, the how we spread the butter.
Right. If you have cliff vesting, get everything at once after 3 years, it's easy.
Ooh.
Straight line method, total cost divided by 3, simple.
The headache is graded vesting, the classic 25% per year schedule.
Here, for service-based awards, companies get a choice. Option A is the straight line method.
So even though it vests in pieces, you just treat it as one big award and smooth the cost over 4 years.
Yes. Most companies do this. It's simple, it's predictable.
But then there's option B, the accelerated method, FIN 28.
Right. And this method treats each vesting tranche as a totally separate award.
Break that down. What's a tranche?
Think of it as 4 mini-grants. Tranche 1 vests in year 1. Tranche 2 in year 2. With the accelerated method, you expense tranche 1 over just year 1. You expense tranche 2 over years 1 and 2. Tranche 3 over years 1, 2, and 3.
Oh, I see the math piling up. In year 1, you're booking all of tranche 1 plus half of tranche 2 plus a third of tranche 3.
You've got it. It creates this massive front-loading effect. Your expense in year 1 is huge, and then it drops off a cliff in the later years.
Hold on. Why on earth would a company choose that?
It's a good question.
I mean, you're making your earnings look worse, not better. Right?
Sometimes it's about wanting to eat the expense early so future years look more profitable. But listen carefully here. This is important.
Okay.
That choice, it's a luxury. You only get to choose between straight line and accelerated if it is a service-based award.
I feel a trap coming.
If you have a performance award with graded vesting, say, you get 25% each year if you hit an EBITDA target. You do not have a choice.
You're forced into one method.
You are forced to use accelerated. Because hitting the target in year 1 is a separate event from hitting it in year 2, the accounting standards say you have to treat them as separate awards. No smoozing.
That is a huge exam detail. So if the question says performance award, graded vesting, and asks about straight line.
The answer is a hard no. It's a classic trap.
Got it. Okay, section 3, forfeitures. Because, people quit. They leave. The options disappear.
Right. So what do you do with the expense you already booked? ASU 2016-09 gives companies another policy choice here.
Option 1 is the estimated method, the old school way.
Yes. You look at your history, you say, we think 5% of our staff will quit this year, and you reduce your total expense by 5% right from the start. You're anticipating.
Like option 2.
Is as they occur. You just assume everyone's going to stay forever. You book the full maximum expense. Then, when Steve from accounting actually quits,
You reverse his expense.
you reverse the expense you've booked for Steve in that specific quarter.
Okay, as they occur sounds way easier.
Administratively, it is.
Yeah. No crystal ball, no guessing.
But, and this is a big but, think about the volatility it creates. If 10 people leave in a bad quarter, you get this huge reversal of expense, which actually makes your income look bigger. It can make the P&L really jerky.
So estimated is a way to smooth things out.
Exactly. And I'll just mention, the book goes into static versus dynamic rates for estimating. Static is just a flat 5%. Dynamic is smarter. It says, someone in year 3 is less likely to quit than someone in year 1. It's more accurate, but way harder.
But no matter which method you use, there's a golden rule, right?
The true up. At the end of it all, your total expense must equal the value of the awards that actually vested. Expense for people who left must be 0. You cannot pay for service that wasn't rendered.
Hold that thought. You cannot pay for service that wasn't rendered. That sounds like just basic logic. But Section 4 is about to just blow that up. Market conditions versus non-market conditions.
This is, without a doubt, the single most confusing concept in Chapter 5. You have to keep them separate in your mind.
Let's start with non-market. Internal goals. Hit $100 million in revenue.
Right. Achieve EPS of $2. These are not baked into the fair value. We treat them like service. We estimate, is it probable we'll hit the target? If yes, we book expense. If sales tank,
We say no longer probable, and we reverse the expense.
Yep, you reverse it. If you miss the target at the end, the total expense is 0. Same as if someone quit.
Okay, that fits the logic. Don't pay for what you don't get. Now, market conditions. Stock price targets. Total shareholder return.
Here, the logic completely flips. Market conditions are baked into the fair value on day one. That Monte Carlo simulation we talked about, it already calculated the probability of missing the target and discounted the award's value for that risk.
So the risk of failure is already priced in.
It's already in the price tag. And because it's in the price, you don't revisit it.
So wait, if I grant an award, vests if stock hits $100. The employee works for 3 years. The stock never hits $100. They get nothing.
Yeah.
What does the company do?
The company still recognizes 100% of the expense.
That feels wrong. The company paid nothing, but it has to record an expense.
Think of it like a lottery ticket.
So,
You pay $5 for a ticket, that's for the chance to win. If you lose, you don't go back to the store and ask for your $5 back.
oh, okay, that actually clicks for me.
Right.
So the employee isn't getting paid for the result, they're getting paid with a lottery ticket.
They received the chance to hit the jackpot. The company paid for that chance. You consumed the value.
And you don't get a refund on a losing ticket.
You never get a refund on a losing ticket. So for the exam, market condition, you never reverse expense if the target is missed, as long as the service was provided.
Market condition is a lottery ticket. Non-market is a conditional bonus. That's the key.
You've got it. That is the fundamental disconnect.
Okay, one last curveball before we hit the knowledge check. Section 5.1.5, retirement eligibility and non-substantive vesting.
This is a huge one for companies with older workforces. The plan says if you're eligible to retire, you can leave and your options continue to vest.
So I could walk out the door today, and I still get the shares in 3 years.
Right. So for that person, is there really a service period? Does that person have to work another day to earn the award?
No, they've already earned it, really. They have the right to it.
So accounting says
Let me guess. You expense it all immediately.
you expense the entire award immediately on the grant date.
Whoa. Hang on. So if I grant $1 million of stock to a CEO who's, retirement eligible,
Yep.
I have to take $1 million expense hit that quarter. Just dot. Bam.
Just bam. You don't get to spread it out. It could completely destroy a quarterly earnings report if you're not planning for it.
And that's true even if the CEO doesn't actually retire.
Absolutely. It's the fact that they could leave. It's the right to leave, not the act of leaving.
That is wild. Okay, we have covered a ton of ground. Now, let's put the listener to the test. I've got 3 scenarios. I want you at home to think of the answer before our expert gives it away.
Let's see if they were listening.
Question 1. A company uses the as they occur method for forfeitures. An employee quits halfway through the vesting period. What happens to the expense the company has already recorded for that employee?
All right, what do you think? The answer is it is reversed completely. Under as they occur, when they leave, you have to back out every dollar of expense you've recorded for them. The net cost must be 0.
Perfect. Question 2. We have a performance award with graded vesting, 25% vests each year if a revenue target is met. Can the company choose to use the straight line attribution method for this award?
Okay, this is our trap question. The answer is no, you cannot. Performance awards with graded vesting must use the accelerated or FIN 28 method. Straight line is not an option.
Question 3. A company grants an award tied to total shareholder return. That's a market condition. The employee works the full 3 years, but the TSR target is missed. The stock went down. The employee gets 0. Does the company get to reverse the expense it recorded?
The final boss. The answer is no. Remember the lottery ticket.
No refunds.
No refunds. The risk was priced in on day 1. The service was provided, so the expense stands.
If you nailed all 3 of those, you are in excellent shape for Chapter 5.
I agree. It all comes down to those 3 things: the time, the method, and the condition.
Before we go, there was one thing I saw. I think it was section 4.6.3.
Yeah.
This idea of spring loading. It felt a little edgy.
Ah, yes. This is where accounting bumps right up against ethics.
It sounds fun, but it's not.
No, it's extremely controversial. Imagine a board knows they're about to announce some huge news, a patent, a big deal that's going to make the stock soar.
But it's not public yet.
Not public. So 2 days before the announcement, they grant a ton of options to executives at the current low stock price.
So they're using the fair market value on the grant date, but they have inside information that that value is about to explode.
Exactly. They are spring-loading the option with guaranteed value. And the controversy is that really fair value? The SEC has guidance on this. It challenges the whole idea that the market price is always the absolute truth.
That is a fascinating thought to end on. Just because you follow the math doesn't mean you've captured the economic reality.
Not at all.
All right. That's a wrap on expense attribution.
Yeah.
Review those implicit versus derived definitions one last time before the exam.
And please check if your executives are retirement eligible. It changes everything.
Good luck. Study hard.
Yeah.
And we'll catch you on the next deep dive.